Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us live from the market site in Times Square, New York City, we have Kevin Mahn, Chief Investment Officer with Hennion and Walsh Asset Management. We're going to discuss what an inverted yield curve means for investors. But first, Kevin, it is great to have you back.
It is great to be back here at the market site, Jill.
Almost literally 2 years to the day. It's great to have you back. And of course, right now we're talking about the inverted yield curve and what it means to investors. Explain to us what that is and why there's some volatility in the market as a result.
Sure. Essentially, an inverted yield curve is when shorter dated maturity bonds have a higher yield than longer dated maturity bonds. That's very rare. In fact, it's only happened 28 other times since 1900 where the yield between the 2-year and the 10-year has inverted, such as it did last week.
And we've been grappling with inflation, rising interest rates, market volatility, and of course, Russia-Ukraine.
Yes.
How is that impacting the Fed's strategy?
Yeah, that's a lot for investors to grapple with right now. And to no surprise, this has been a very volatile start to 2022. A lot are fearing now that a recession perhaps is imminent. And let me give you this stat. So of those 28 yield curve inversions since 1900, in 22 of those instances, a recession has followed, but not immediately, Jill. In fact, on average, it takes another 22 months for a recession to start. And the stock market generally moves higher over the course of those periods of time. So this isn't necessarily a situation where investors should run to the sidelines, but they should look to diversify their portfolios more and perhaps position them to take advantage of rising interest rates, which we know is going to start coming from the Federal Reserve.
Right, and I'm glad that you brought up 22 out of 28 times we head into recession. And it feels as if we've been injecting liquidity into the system, certainly over the past decade, to kind of prop up the market and the economy. But isn't a recession a natural part of the business cycle?
It absolutely is, and we shouldn't necessarily fear a recession, but perhaps prepare for it. But again, a recession is not in the near-term outlook, not least what we believe here at Hennion and Walsh. In fact, we believe the economy will continue to grow, albeit much slower than where it grew at in 2020 and 2021. And we think if, in fact, the Fed does become more aggressive, as they're suggesting they will, with a 50 basis point rate hike at their next meeting in May, and starting to unwind their balance sheet by selling off bonds to the tune of $95 billion a month, investors should position their portfolios into those sectors that have historically done well when rates rise.
And we're going to get into that, but what could the next potential steps be for the Fed, what you call the TNT approach?
Yes, absolutely. So TNT, of course, stands for tapering, narrowing, and tightening. The tapering is done. They're no longer purchasing bonds each month. The narrowing of the balance sheet is actually going to start now, as we understand, with a $95 billion reduction per month. Remember, they have a $9 trillion balance sheet, so that's only a small pittance of what's out there overall. But that's very important, Jill, because that impacts the longer end of the curve. And if the longer end of the curve is impacted, we don't have to worry about this inversion that's taking place right now, because the Fed, by raising their interest rates, or the last TNT, the tightening, impacts the shorter end of the curve. So it's going to be a dual approach from the Fed to try and combat these record-setting levels of inflation without pushing us into recession.
So how do you position in a rising interest rate environment? I mean, there's so many variables out there that the market investors are dealing with.
Certainly, and we looked at the last 8 times when, in fact, we've been in a rising rate cycle. And what we found is actually the stock market does pretty well. On average, over those 8 previous times, the market's moved higher by around 43%. And then when we dove into the last 4 rate cycles, we found 4 sectors that perform best on a relative basis. They are technology, which has really been beaten up this year, energy, utilities, and in industrials, and throw in financials as your 5th. We think those sectors can provide good opportunities for investors to take advantage of a rising rate cycle for the next 2 to 3 years.
It's almost like if you put your longer term hat on, right? Ignore what's happening in the media, ignore what's happening on social, kind of step away from the headlines and just do your fundamental work and stay diversified. I mean, you've been on the show for 5 years and it always comes back to diversification.
Absolutely, absolutely. Stay true to what your risk tolerance is. Keep in mind what your longer-term financial goals are, and don't be whipsawed into believing that you have to make an immediate move just because of what the headlines say. Put it in perspective, look at what history suggests may happen, and work with experienced portfolio managers or financial advisors that guide you through those difficult and turbulent markets.
All right, Kevin, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.